Warren Buffett is arguably the greatest investor of all time, next to Nancy Pelosi, of course.
This is a free market.
Now, he started out selling gum and Coca-Cola door to door, but he now receives a $776 million dividend from Coca-Cola every single year, which is quite a turnaround if you ask me.
Not bad at all.
Many have studied Warren Buffett's investment strategies, but I wanted to do it with the help of AI because frankly, AI is smarter than us. It processes thousands, millions of things per second and can just compile a ton of data really quick to give us some of the best insights. This video gives a unique and unmatched glimpse as to how Warren Buffett approaches his investing through a conversation I had with my AI assistant, Tiara. And here's how that conversation went. Hi Tiara, I really look up to Warren Buffett as an investor and would love to mimic his strategy as much as possible. Can you analyze his trading strategy and help me understand his key trading principles?
Warren Buffett is indeed a great investor, and his company, Berkshire Hathaway, has many years of beating the market. His investment philosophy is deeply rooted in the principles of value investing, a concept popularized by his mentor, Benjamin Graham. At its core, value investing is about finding stocks that are undervalued by the market but have strong potential for growth. Here are some key aspects of this philosophy. Intrinsic value. Buffett focuses on the intrinsic value of a company, which is essentially what the business is worth based on its fundamentals, such as earnings, dividends, and growth potential. He looks for stocks that are trading below this intrinsic value, providing a margin of safety. Margin of safety. This is a crucial concept for Buffett. It means buying stocks at a price significantly lower than their intrinsic value, which reduces the risk of loss and increases the potential for profit.
At this point, I had to better understand how to analyze the intrinsic value of a company. To be honest, this could be a whole new video in and of itself, but Tiara broke it down into 4 different things I need to pay attention to. Price to earnings ratio, discounted cash flow analysis, dividend discount model, and asset-based valuation. Now, while I'm not gonna go through all those here and dive really deep into it, Buffett really likes that, measuring intrinsic value, and that's exactly how you can do that. Interestingly, the next 2 parts about his philosophy might be even more important than that.
Buffett invests in companies with solid financial health, strong earnings, and a history of consistent performance. He pays close attention to metrics like return on equity and profit margins. Unlike many investors who chase short-term gains, Buffett is known for his patience. He buys companies he believes in and holds on to them for the long haul, allowing the power of compounding to work its magic.
And to my credit, these last 2 parts, this is something that I actually stick to myself, and I think a lot of people would benefit from. Whenever I invest, I always look at the company from a long haul perspective and not necessarily like a 1 or 2 year time horizon. I believe in investing in companies that have solid fundamentals and understanding their growth, their opportunities, and what they're currently developing, as I think that basically alludes to what will happen with them in the future. But that's the way that I do it, and frankly, this video is informational. So if you're interested in making your own moves, that sort of thing, that's great. Make sure that you do your own research and speak to a professional before you make any decisions. Next, Tiara dove into some of the components of Buffett's strategy. And frankly, to me, this is some of the best parts of the whole conversation.
Buffett looks for businesses with a durable competitive advantage, often referred to as a moat. This could be a strong brand, unique products, or efficient cost structures that protect the company from competitors. Additionally, he places great importance on transparent and capable management teams. He believes that good management can drive a company's success, so he often invests in businesses led by people he trusts and respects.
This makes sense, but I think it's a little hard for someone like you or me to properly analyze a management team. The reality is Warren Buffett can walk into any company and they'll welcome him with open arms and he can speak to him face to face. You and I, we can't really do that as much.
He also pays close attention to specific financial metrics when evaluating a company. A few of those metrics are return on equity. This metric indicates how effectively a company is using shareholders' equity to generate profits. A consistently high ROE is a positive sign. Profit margins. Companies with strong profit margins are often more resilient to economic downturns and competitive pressures. Debt-to-equity ratio. Buffett prefers companies with manageable debt levels, as excessive debt can pose risks, especially during economic downturns.
This reminds me a lot of the recommendations from another video that I did with Tiara, where she said how to pick and analyze stocks. Now, I'll link to that here at the end of the video, so don't worry about it right now. But that was really interesting because it really helped me understand what metrics you should be looking at when you're looking to try to pick the right stocks.
Lastly, a cornerstone of Buffett's strategy is his focus on buying undervalued companies and holding them for the long term. He believes in the power of compounding, where the value of an investment grows exponentially over time. This patience allows him to ride out market volatility and benefit from the sustained growth of his investments. These components work together to form a robust strategy that prioritizes quality, value, and long-term growth. By focusing on these areas, Buffett aims to build a portfolio that can withstand market fluctuations and deliver consistent returns.
Determining if a company is undervalued is actually pretty simple to do with a price to earnings ratio or a price to book ratio analysis. But if you want to go deeper than that, which I would personally if I was trying to invest like Warren Buffett, who tends to really pile in on a stock, there's a lot of other metrics that you have to look at as well. Next, let's get into some of the common misconceptions about Warren Buffett's strategy. I actually thought this part was really interesting and spot on.
When it comes to Warren Buffett's investment strategy, there are a few common misconceptions that often arise. One misconception is that Buffett only invests in large, well-known companies. While it's true that many of his investments are in big names, he focuses more on the quality and potential of the business rather than its size.
That's what she said.
He looks for companies with strong fundamentals and a durable competitive advantage, regardless of their market capitalization.
This is completely true. So about a week ago, I was browsing the top 50 holdings of the Berkshire Hathaway company. And while there was plenty of companies that I did recognize, there was also some smaller companies that I had never ever heard of.
Another myth is that Buffett avoids technology stocks altogether. Historically, he has been cautious with tech investments due to their rapidly changing nature and difficulty in predicting long-term success. However, he has made exceptions, such as investing in Apple, when he sees a strong moat and reliable earnings.
This was really interesting because, as we all know, tech stocks have just been on a tear. Now, can you imagine if Warren Buffett would have been really bullish on Meta or Nvidia? It would have been crazy. But the guy, he sticks to what he really knows and what he really understands. So you have to respect the way that he does it.
Lastly, some people think Buffett engages in short-term trading to capitalize on market fluctuations. In reality, his strategy is centered on long-term investments. He believes in buying quality companies and holding them for years, allowing the power of compounding to work in his favor. These misconceptions can lead to misunderstandings about how Buffett achieves his investment success. By clarifying these points, viewers can better appreciate the nuances of his strategy and apply similar principles to their own investing.
I know that day traders are going to hate this one, but it is true. Overall, Warren Buffett / Berkshire Hathaway, he holds on to his positions for a pretty long time, almost always. In fact, I would argue that when they actually sell something or when he sells something, that's usually bigger news than when he buys it. Warren Buffett's portfolio strategy is a masterclass in disciplined investing. By focusing on intrinsic value, business fundamentals, and a long-term perspective, the guy's done an amazing job and he's beat the market year in and year out. And because I said that I'd share it earlier in the video, this video right here is the one that'll help you understand how to properly analyze and pick stocks. And if that one's not for you, you can click right here for my most recent video. If you enjoyed this video, please do me a favor, click on the like button so YouTube will share it with other people. And as always, make sure that you subscribe to Unlock Financial Success, one AI chat at a time. Thanks for watching.